Let's bring on board Amit Goel, co-founder and chief global strategist at Pace 360, to talk to us about what he's seeing both domestically in the Indian market as well as globally. Hi Amit, good afternoon. Good having you. I want to start off by first understanding. You did call a rally when we spoke maybe a month and a half back. That's played out, at least on the Indian market. So congratulations for that. How are you placed now, and what are you anticipating? What are you penciling in?
Hi, Harsh. Thank you for having me on. My understanding is that the rally has largely played out by now. And NIFTY, if you note, for the last 20 odd days has largely been sideways. So it made its rally high around 3 weeks back at 25,100 odd, and it is still about 300, 400 points lower than that. But in the meanwhile, the small caps have been absolutely, it's been a slow burn, but it's been a massive rally in the small cap and mid caps over the last few weeks. And in fact, we made a new rally high today in BSE small cap index at about 53,400, 500 odd. My sense is that the rally has largely played out. We are now bearish for the medium term and for the longer term. And we believe that the global recession, which has been much talked about, the probabilities of the global recession went up in April uh, when the tariff wars were at their peak. But many Wall Street banks have taken down those probabilities in the last few weeks. But my sense is that a global recession and a severe slowdown is literally lurking around the corner. So I think we are going to be in one within the next 6 to 9 months. And yesterday's data in US, whether it was the jobs data or the services data, they are all pointing in that direction that a slowdown is now gradually it's now happening. It has begun to happen, and I think it's going to unfold over the next 2 to 3 quarters.
Okay, and how does India stack up there, Amit? So what's the sense like with regard to India, the index, the benchmark?
So I think Indian market has yet again become very expensive, and so the comfort which we had in March and then in first half of April, where we thought that the markets have where we thought that the markets have come down, the valuations were looking comfortable, there was a lot of panic, and we decided to go long, and we decided to increase our allocation to equities very, very meaningfully. We don't feel that confidence at all now. So I think there is euphoria yet again. The valuations are very, very steep. And my sense is that while the last quarter's GDP growth has been pretty good in India, but then there were a lot of factors. The fact that the government opened its purse strings after 2 quarters of relatively tepid spending, then Kumbh, and then, of course, the last quarter of the financial year. So, a lot of factors came together to give us a bounce in the Q4 of 24-25. But I see this growth momentum slowing down, and I see the GDP growth numbers now gradually going down in India. I'm not saying that we are going to go down to a 5% growth within the next 2 to 3 quarters. I think it's going to happen very, very gradually. But in case the global slowdown becomes more serious, which is my base case over the next 2 to 3 quarters, my suspicion is that the Indian numbers would also become more tepid because the global cycles are a lot more synchronous than they used to be. So India is also not looking great from an economic standpoint, from a corporate earnings standpoint, and from a valuation standpoint. We are literally one of the most expensive markets in the world even now. So I don't think things are looking that great for India if you were to look 2 or 3 or 4 quarters out. And my suspicion is that it's going to be a relatively a relatively longer recession. It's not going to be a blink it and you miss it kind of recession or a bear market. It's going to be a slow and protracted recession and a bear market. So things look pretty challenging ahead. And in my opinion, it would not be a bad idea to take money off the table, reduce your allocation to equities, and then wait for the next best opportunity to buy into a correction and then again book profits when the market normalizes, similar to what we did between March and May of I mean last 2 months.
So, are you sitting on a lot of cash right now, Amit? You seem very bearish.
Yes, I am. I am quite bearish at the moment. We have, but I would not say that we have cash. So what we have done is we have taken some calls on long duration in India, and we have put a lot of money into corporate bonds which are maturing in the next 2 to 3 years. So our bond portfolio is giving us a carry of about 10.5 to 11% right now, and we are pretty happy with it. So we don't have cash as such, because it's not that we put money into a liquid fund. We are getting a pretty handsome carry of about 10.5 to 11% on our portfolio. We are very happy with it. But of course, we would want to point out that if something goes wrong in the world economy, if if the tariff wars were to begin again, or this problem on the rare earths becomes more serious, or any other flashpoint in the geopolitical situation happens, then we would be back in the market in case there is a deep correction. But that is the caveat: we would buy only if there is a deep correction, and that would not be from a long term standpoint. We would buy it from a short term to a medium term standpoint. But yes, as of now, my equity allocation is about 15 odd percent, and rest of the money is invested into fixed income.
Okay, Amit. Amit, what do you suggest? Should one move to fixed income at this point as well? Is it still looking as lucrative? Because we've seen a slight bit of tweak on the bond yield.
I agree with you, Harsh, that in the very, very near term, we do not see enough catalysts to for the long-term yields to come down drastically. It's probably not going to happen in the next, let's say, a couple of months. But we have invested at a slightly higher yield, so we are sitting on some profits there, and we would want to ride it out, because my sense is that in the second half of this calendar year, and particularly in the last 4 months of this calendar year, when this global slowdown becomes more serious, there are going to be a series of rate cuts from in US, and of course, which would open the possibility for the emerging market central banks also to cut interest rates. So my sense is that duration is going to play out over the next 1 to 1.5 years. We can probably ride this. It's not a great entry point as such right now, but we would want to ride this for the next 1 to 1.5 years. And my rest of the money is, of course, in corporate bonds, where we would want to buy equities if they were to correct, or we would also want to buy gold if it were to correct by about 15% or so from the current levels. So we see opportunities outside the fixed income space, but only when a correction happens. Right now, equities and even gold is relatively close to the higher end of the spectrum in our opinion, and the upsides are much less than the downsides.